Hi, welcome back to another YouTube video for Always Bookkeeping. My name is Tony. I'm one of the owners here at Always Bookkeeping, and today we're gonna be talking about how to start paying $9,293 in CPP as a self-employed proprietor Canadian. So if you're a self-employed proprietor person in Canada and you're tired of paying CPP, both side employer and employee, this video is for you. If you are a sole proprietor, CRA treat your business income as your self-employed income, and that means that you can get hit with both CPP as an employer and an employee when you get salary from your company. And for 2026, the maximum self-employed CPP can be over $9,000 when you include the base CPP and CPP2. But there is a way that many business owners in Canada avoids paying CPP completely. That is getting yourself incorporated as a business. And when you get incorporated as a business and pay yourself as a dividend, you instead of a salary, you will avoid paying CPP completely. And CRA states that self-employed CPP is based on your business income. And in 2026, your base CPP is to $8,460 for the maximum amount, and the CPP2 maximum amount is $832. That combines bring you to $9,293 in total CPP if you make enough income as a salary employee for your company. And number one, self-employed as a sole proprietor equals CPP. Here's a problem with staying as a sole proprietor. When you are a sole proprietor, your business income is your personal income. There's no difference between your business and your personal. Your business is your personal. And when you file your T1 every year on your personal tax return, you report your net business income as your personal income, and your CPP is now calculated based on that amount. You do not, as a business owner and just you as your business, you do not have an employer to pay for that CPP. You are the employer. So now you have to pay for both sides of the CPP. So your employer side and your employee side. So if your business is having enough high profit, you can end up paying a full CPP amount, CPP1 and CPP2. That's why so many sole proprietorship, business owners get surprised at tax time, because you're not just paying the income tax, you're paying CPP on top as well. And number two, incorporation changes the game. Now, here's where incorporation changes everything. When you incorporate, your business become a corporation, so your net business income is different from your personal income. And the corporation earns a business income first. You personally do not report that income as a sole proprietor business income anymore. Instead, the corporation pay you in a different ways. It can pay you a salary, or it can pay you a dividend. And if your goal is to stop paying CPP completely, then you have to stop paying yourself a salary and have to switch to just dividends. Number three, salary is a trap. Let me make this very clear for you. So even if you incorporate as a business and so pay yourself as a salary, you will not avoid paying CPP completely. Salary is employment income, and that means payroll, that means CPP deductions, that means T4 slip, so you have to pay CPP on both employer and employee side. So if you incorporate and still pay yourself a salary, you are not gonna escape paying the CPP completely. The dividend strategy only work when you pay yourself as a dividend instead of a salary. So no salary, no T4, no CPP, strictly dividends. Dividends are a strategy. So what is a dividend? A dividend is a money paid to a shareholder of the corporation. So you as a business owner, you can also be a shareholder of your own corporation, and that's how you're gonna get paid as a shareholder. You are not being paid as an employee, you are being paid as an owner now. And that difference matters. CPP applies to pensionable employment income and self-employment income. So dividends are not wages. Dividends are not sole proprietor incomes. Dividends are paid from corporation after the tax bill to the shareholder. So when your corporation pay you a dividend instead of a salary, there is generally no CPP on those dividends. That is the entire strategy. As a sole proprietor, your profit flow into you personally and CPP apply. As an incorporated owner, as a corporation owner and you still take salary, CPP still apply. As an incorporated owners and take dividend, CPPs do not apply. CRA described taxable dividend as distribution from a corporation to shareholders, while CRA's CPP guidance says self-employed CPP is based on net business income and not other income such as investment earnings. Next is a very simple example. Let's say you are self-employed and your business is making enough profit that you're maxing out your CPP. As a sole proprietor, if you are taking home around $85,000, you're going to have to pay the maximum amount, which is a CPP base amount and CPP 2 amount. But if your corporation pays you dividend, you can remove that CPP cost entirely from your take-home money. You still pay tax, just income tax and also CPP on top. That's the difference, and that's the $9,293 that you can save within a fiscal year when you get paid as a dividend shareholder owner of your corporation instead of getting paid a salary. So this is how it looks in real life. Step 1, you incorporate your business. Step 2, the corporation invoices your clients. Step 3, the money goes into the corporation bank accounts. Step 4, the corporation pay expenses like your bookkeeper, your accountant, advertising, and so on. And step 5, the corporation pays corporate tax on its profit. Step 6, instead of running payroll for yourself, the corporation declares and pays dividends to you as a shareholder. Step 7, those dividends are reported on now a T5 slips instead of a T4 slip like before as an employee. So no payroll to yourself, no salary to yourself, no T4 employment to yourself, and no CPP on the shareholder dividends. So that is the dividend only structure, and you avoid paying the CPP completely as a shareholder now of your corporation. Bookkeeper explanation. As a bookkeeper, this is where we keep your records clean. When the money comes out of the corporation, we have to record it properly. It should not just be a random transfer from the corporation to yourself. If it's a dividend, it has to be recorded as a dividend. If it's a shareholder loan repayment, then it should be recorded as a shareholder loan repayment. And if it's a reimbursement for business expense, then we have to record it as a business expense on your corporation. But do not call everything salary. If the goal is to avoid CPP completely, salary creates payroll, payroll creates CPP, and CPP creates more expenses on your take-home money. So if you want to take home more, then you have to avoid salary completely. So here's a simple version. If you are self-employed as a sole proprietor, you cannot just tell CRA, I don't want to pay CPP anymore. That's not how it works. The strategy and the structure is how you avoid paying CPP. You can incorporate your business. You can stop reporting business profit as a sole proprietor income. You can pay yourself as a shareholder with dividend only on a T5. And that is how incorporated business owner avoid paying CPP completely. Again, not salary, not payroll, strictly dividend. So if you are self-employed sole proprietor in Canada and want to avoid paying CPP completely, you cannot stay as a sole proprietor. You have to get your business incorporated and pay yourself as a dividend instead of a salary. And that is how you stop paying yourself. That's how you stop paying $9,293 in a year into CPP. And if you want more bookkeeping and tax tips, subscribe, and comment what you want to hear and see from us in the next video. And if you want to learn more about us, you can reach out to us at info@alwaysbookkeeping.ca. Book an initial consult with us. It's free. You can go on our website at www.alwaysbookkeeping.ca to book your initial consult, or give us a call at 780-554-8356. Again, it's Tony from Always Bookkeeping, and I hope you liked the video. So that's how you avoid paying CPP completely as a self-employed business owner in Canada.